I just arrived a little while ago, and we want to thank our sponsors. As you can see, we have numerous sponsors who help underwrite the research program that goes into compiling these numbers. I sometimes will explain to people that cpm-group is simultaneously the lowest cost and highest cost source of data for precious metals. We're the highest cost because we spend an inordinate amount of money, more than anybody else, I'm sure, in gathering statistics around the world on supply, demand, investor trends, and other trends in the market. And we spend a lot of resources analyzing the silver market and performing economic and econometric analyses on the markets, not only for silver, but gold, platinum group metals, strategic metals, and a host of other commodities. That makes us also a very low-cost source for research because we've got this database, and we've maintained this database. I've been working on it since 1980, but the database was actually created in the late 60s and has been added to and extended ever since then. And it's an extremely expensive process to develop that and maintain it, and our sponsors help us defray the costs of doing this and bringing the reports to a broader audience. So we have a number of producers. We have refiners like Sabin Metals. We have several exchanges, including the CME Group and the exchanges that are run by the Financial Technologies of India, including the MCX, which is the second largest silver trading exchange now. We have the Silver Users Association, which is an association whose members probably consume about 90% of the silver used in the United States. I wanted to start with this slide. As I said, we've been compiling these statistics since the 60s, 70s. And according to our numbers this year, the cumulative production of silver since mankind began mining silver surpassed 50 billion ounces. Gold in 2011 surpassed 5 billion ounces. And that initially sounds outrageous to be able to make that kind of claim, that you could count the amount of silver and much less gold that's been mined throughout history. But if you look at this chart, you'll see that about 80% of the silver that we estimate to have been mined has been mined since 1900, and about 90% of the gold. So that is a time when most of the silver was produced by corporations that kept good records. And you can see also that a significant portion of the remaining amount of silver has been mined since 1800, both by corporations and also in situations where the silver and gold that was being mined by individuals often was sold to mints, so the mints kept records. So the idea of counting cumulative silver production isn't so outrageous, because at the end of the day, you only have about 5 or 6 billion ounces of silver that are estimated to have been produced prior to 1800. So more than 95%, or more than 90%, or roughly 90% of this 50 billion ounces has been produced in relatively recent times, and the vast majority since 1900. The more hubristic is the disposition of it. And those of you who have seen our gold research know we have estimates for the location of 1.2 billion ounces of gold in investor holdings, 1.0 billion ounces in central banks and international organizations, 2.4 billion ounces in jewelry, decorative objects, religious goods, and about 90%, all but 10% of world's gold production is believed to be relatively identifiable and recoverable under some circumstances. In silver, more than half of the silver is unidentifiable. That's one of the big differences in the silver market from the gold market. There are several key differences, and that's one of them. Silver is less valuable metal per ounce. It gets lost. It gets used. It gets used in things like mirrors and ball bearings and solders, from which it does not get recovered. So that's a little trivial history about that. The first section of my presentation covers the economic environment. We have held to what is perhaps a more sanguine economic outlook over the last few years than a lot of people in the precious metals markets, in that we didn't think that the world financial system was going to collapse. What we expected was an astringent period of time in which we had a number of economic and financial problems that would persist not for years, but for decades. And the working title of our main economic scenario is muddle through. And we continue to see that. We have seen that over the last couple of years, and we continue to see it. These are the IMF's statistics on actual historical gross domestic product, broken down into industrialized countries, global totals, and emerging economies, and then their projections. And the dashed lines are the projections from January, and the solid lines are their recently revised projections that they released last month. And you can see very steep recession, 2008, 2009, very steep recovery, 2010, 2011, 2012, kind of sideways. A little bit of a pickup they anticipate in 2013, 14, and then moving sideways. Our actual views, we used the IMF's data as our base. Our views are a little bit less sanguine than the IMF's going forward. This is our world total, and it is a little bit more flat. We don't have quite as pronounced a recovery in 2013, 2014 as they have. A little bit subpar, lower growth than we had expected. And Chinese growth also moving sideways to lower in the forecast period and staying much lower than it has been really over the last 20 years. This only goes back to 2000, but if you take the Chinese GDP figures back to 1990, you'll see that Chinese GDP basically was above 8–9% for most of the last 22 years. It's coming down now. During that period of time, it's important to understand the Chinese government's target GDP rate was about 8%. They wanted 8 or 9% GDP. They consistently had 10, 11, as you can see here in 2007, it got up to about 14%. The Chinese economy consistently overperformed the Chinese government's desired target GDP. Now the GDP is coming down to about 8%, 8.2% this year. They're actually achieving their target. It's what a lot of economists had expected. And in the precious metals market and in the financial press, you'll find people throwing their arms up and they saying, oh my God, China is moving into a recession because it only has 8% GDP, which is, by the Chinese government standards, a success. Their policies are finally clicking with their overall economy. Obviously, with silver and gold, the currency markets are very important. They're more important now than they used to be because a lot more institutional investors trade silver off of the dollar. So when the dollar's rising, they sell silver. When the dollar's falling, they buy silver. Our view has been that the dollar will continue its long-term. You can see here that the dollar has been deteriorating in value. The green line is against the euro, and the black line is on a trade-weighted basis. It has performed more poorly on a trade-weighted basis because a lot of our trade is with China, India, Brazil, oil exporting countries, so that the trade-weighted dollar has been weaker than the dollar against the euro. And that reflects the fact that the European economy has been not as strong as the U.S. economy, and it has more structural issues to deal with than the U.S. economy. We expect the dollar to continue to move sideways with a slight upward bias against the euro, and on a long-term basis, we expect the dollar to continue to deteriorate again on a trade-weighted basis. This is U.S. unemployment, and another thing that you often hear is the U.S. unemployment is persistently high. If you look at the slope of the decline in unemployment rates since the recession 2 years ago, you'll see that the slope in the initial period basically has been the same as what you saw post-recession in 1992 and post-recession in 2002. The problem is that it's now moving sideways, coupled with the fact that it's very high. This only goes back to 88, I think. If you took it back to 1980, you'd see that Unemployment actually got up to 11% in that recession and came down at approximately the same pace. So what we are seeing is a reduction in unemployment as the economy recovers, but it is a slow, painful reduction. And that's because, to use the term in the market, the U.S. economy is deleveraging. We're reducing our debt on a corporate and a personal level. We're consuming less. And when you consume less, you're hiring fewer people to either make the things you consume or serve them to you. And so we're seeing unemployment persistently higher simply because we are, in fact, reducing our debt. And that reduction in debt reduces consumption and helps keep the unemployment rate higher. Coming close to silver now. People ask us, is silver a financial asset or is it an industrial commodity? And it's both. This chart here shows global industrial production, the blue line, year-over-year changes in global industrial production, and the red line is silver price changes year-over-year. There's about a 64% correlation. So clearly industrial production and the industrial use of silver has a lot to do with determining the price of silver. But that relationship is clouded, and it's probably higher than you would think otherwise, simply because industrial production changes in industrial production levels in turn flavors investment demand. So investors will key off of industrial production figures and buy or sell silver based on that. So the relationship of 64% to industrial production and silver prices actually reflects both the industrial nature of silver and the investment nature of silver. Let's go into silver prices. We all know what silver prices have been doing. They've been very high. As I said, I was just in Lima. Yesterday I gave a talk on the outlook for gold and silver. People were very upset with our view that the price of silver could trade between $20 and $30 over the next couple of years. I did not point out to them that prior to November 2010, the price of silver had averaged over $24 in a total of 2 months back in early 1980. So prices of $24 are incredibly high, as you can see here. And even if the price does come off that much, we're not suggesting that it's going to come off that much this year or next year. Well, maybe next year. But the fact of the matter is silver is extremely high, and even coming off of its peak remains very high by historic fashions. This time, 2 years ago, the price of silver was $15 an ounce. So it's down to 27 yesterday, it's up to 27.50 today. It's still very high. And it's very attractive for producers. On an inflation-adjusted basis, it's clawing its way back. These are quarterly averages. It's clawing back to its quarterly average that we saw in 1980. And let's look a little bit more at what happened last year. The price of silver rose January, February. It actually fell in January, rose February, March. During April, it went from $37 an ounce to $49. It got to $49.82 on an intraday basis in the last week of April. That was a record high intraday price on the COMEX. In the OTC market, it got to $50 back in 1980. But in terms of the spot, the first nearby actively traded COMEX month, that $49.82 last April was a record price. It didn't quite make it to the high settlement price of 1980. It was about 18 cents shy of that. And on an annual average basis, it blew the record books away. The prior average was in 1980, it was a little over $20. In 2010, it came close to that, but didn't surpass it. And last year's average price was about 73% higher than 2010, around $35 an ounce. So we saw record prices. Now, as we talked about last year when we released the 2011 Silver Yearbook, what happened during April was not a surge in investment demand. Coin sales actually were a little bit off. Coin premia weakened as people pulled back from buying while prices were rising. And the ETF holdings basically were flat. They rose a little bit, then they fell a little bit, and then they rose a little bit. They were basically flat. You did not see investors buying a lot of physical silver in April, driving the price up last year. What you saw last April was an enormous amount of May COMEX open interest, 370 some odd million ounces, that was bought back by the people who were short that and rolled forward. So they buy back the May, they sell forward in July or December, and that was what pushed the price of silver up. As a consequence, once we got to May 2nd last year and the May COMEX roll was behind the market, the price came off with a thud. And within a week, it was back down to about $33. It came back up, got up to about $44 in the summertime. That was right when gold was making its peak and when there was a great deal of fear, both about the European debt situation and also about the U.S. debt ceiling discussions and the downgrading of U.S. Treasury. And then after that, in the middle of September, late September, investors sort of said, well, maybe the world's not going to collapse. And they backed away from gold, they backed away from silver, they backed away from a lot of assets. And we saw a big sell-off in gold and silver, as well as stocks in late September, and the prices kind of moved sideways since then. What we're seeing in silver and gold since September is that when the price comes down, people buy more coins, they add to their ETF holdings, and when the price goes up, and up now is $36, people pull back from buying physical silver. So this is contributing to our view that we have, in fact, seen a cyclical peak in the silver price last year, both on an annual average basis and on an intraday basis, and that the price probably will trend lower both this year and into next year. This is silver price seasonality, and our new model has a really cool addition to it. The salmon-colored bars represent silver price seasonality over, I think, 20 years. And what you can see is that the price tends to be very high in the first 5 months of the year. It weakens in June. It gets much weaker in July and August. And then it starts rising in the final 4 months of the year. And there are industrial reasons for that. A lot of silver-using industries go on vacation in July and August, do inventories, go into rolling shutdowns. And there's also some investment reasons. Investors go away to the beach in July and August. They don't make big strategic decisions. They read a book on the beach. They come back in September. They start implementing the changes that they've had in their minds, and you start seeing some strengthening in silver prices. The gray bars is the silver price seasonality, but it's weighted to give more emphasis to recent years' seasonal patterns. And what you can see here is that the seasonality has become more volatile, higher highs and lower lows. So if you look at this thing, what you're seeing is a market that is much higher typically in March than it used to be, and suggesting that this year you're going to see much lower, weaker prices in July and August. That's interesting because if you talk to silver fabricators, and you know who you are, if you talk to silver fabricators and companies that are using silver, what we're finding is that a lot of people think that it's going to be a particularly quiet summer. And they're looking for weaker demand for their products and consequently weaker demand for silver on their part. And here's the gold-silver ratio. And those of you who know us know that we put no stock in the gold-silver ratio. If you ask us where the gold-silver ratio is going to be in 2 years or 5 years or 10 years, we'll look at our 2-year, 5-year, 10-year projections of gold, divide them by our projection for silver, and we'll come up with the ratio. But we have said that given our expectations that silver would outperform gold for the next couple of years, and then gold would outperform silver, we have said that we thought that you could see a decline in the gold-silver ratio, which we have seen. It's coming back some, but we think it may have a little bit more to go. But then later in the decade, you may see gold rise in value relative to silver, depending on what happens in the world economy. Going into the numbers, the supply-demand numbers, investment demand is the key to determining silver prices. And you can see here, this chart goes back to the 70s. You can see here that over the last 3 years, and we have a projection for 2012, investors have been buying about 130 million ounces of silver a year. That's a very high amount of silver. In fact, on this chart, you can see 2 years, 1980 and 1983, when investors bought more silver than that. And if you take this data back to the 1950s, I think there's one other year back in the 60s when investors bought more than that. So investors have been buying a lot of silver over the last 3 years, and they look set to continue to buy a lot of silver again this year. And that has been the primary factor driving. You can see the black line. You can see the price consequence of that investment demand. The other thing that you can see is that when investors turn bearish on silver, the first thing they do is they pull back from buying. So if you look at the 1980s, they surged into the market in 79 and 1980. They continued to buy into 83, 84, 85. But as the 80s progressed, the stock market was doing well, the global economy was doing well, the dollar was doing well. People started walking away from buying silver. So that by the late 1980s, you actually had the Silver Institute ask us for a study, why is the silver price weak? And our answer was because investors aren't buying it and banks and brokers aren't selling it to them. And then in 1990, they became net sellers. They continued to be net sellers throughout the 90s into 2005. The last 6 years, they have now reemerged as buyers. We expect a similar pattern. We expect demand to stay high for a couple of years. If the world economy doesn't collapse, if the European economy doesn't collapse, and we don't expect either of those things to happen, we think that as the decade progresses, you'll see some softening in investment demand for silver, which could be reflected in prices. These are our estimates of reported and estimated silver bullion inventories. And we measure inventories in different ways, and we trade different methodologies off of each other. And this chart only goes through, I think, 2011, this chart's a little bit different than in the book. In the book, we have about 1 billion ounces of silver in bullion inventories and another 900 million ounces or 990 million ounces in coins. So investors and others are holding close to 2 billion ounces of silver in coins and bars right now, which was shown in the earlier chart too. You can see the long decline in those inventories, and you can see the steady increase over the last few years. A significant amount of that silver is now held in ETFs, about 600 million ounces of silver. And the ETFs in silver are much more important as a mechanism for investors to buy physical silver than are the gold ETFs. In the gold market, the ETFs represent about 10-20% of annual net investment demand for gold. And there are about 80 million ounces of 1.2 billion ounces, so they're less than 1%, or 10%, less than 1%. They're about 0.7, 0.8% of total gold holdings by investors. In the silver market, you can see that the ETFs have become a much more important method for people to buy physical silver, and it's a much more important part of the market. Last year was an exception. We saw investors, unfortunately for those investors, they didn't sell their silver ETF holdings when the price was rising in April. They sold 60 million ounces of it after the price had fallen. Now, if you look at the numbers, it looks as though most of those investors who sold when the price came back off to $33, $35 an ounce actually had bought it earlier at prices below $33 an ounce. So they didn't necessarily lose money, but what you saw was a sea change in investor attitudes away from this, the silver price can only rise, to I think I'll be a little bit more cautious in my bullishness towards silver. And coin demand has risen very sharply. It's at a lower pace in the first few months of this year. So we're looking at about 74, 75 million ounces of silver to be bought in coins this year, which is down from a little over 90 million ounces. But you have to compare that to the 25, 30 million ounces of annual coin use over the last 20 years to see that it's still pretty high. And futures volumes have been rising sharply. You also have seen some increase in London trading over the last couple of years, but it's not back where it was in the 90s, when you had a lot more proprietary trading in the OTC market. But you've seen this big growth in futures and options volumes. And here's the same thing here. Trading volumes at the major exchanges, it's not at record levels. It's way at record levels, far, far higher than it was back in 79 and 80. Interestingly, call option positions, the open interest in call options has, on the COMEX has fallen sharply, which tells you a couple things. The easy analysis is that a lot of investors who were using call options to buy upward exposure to higher prices have stopped buying those call options. You have to be a little bit cautious there because other people buy call options for other reasons. So if you're a producer or a refiner or a bank that is leasing silver out to a manufacturer, you might be hedging your position with call options. And so what you may be seeing is some of those hedges actually being unwound and less hedging going on, as well as investment demand. So call options are not necessarily a great measure of investment demand, but you can assume that perhaps a big part of that decline does in fact reflect investors pulling away from bullish bets. And that's reflected in this, which is these are non-commercial, so institutional investors and large funds, net and gross positions on the COMEX, futures and options. You'd see it was very high. It's been persistently high. The blue part, which is the gross shorts, have been very small for about 5 or 6 years, and they continue to be small, but we have seen a reduction in the gross longs over the last year or so. Supply is growing and is continuing to grow. Another difference between gold and silver. Silver mine production has been rising at a fairly fast pace really since the 80s, early 90s. Gold peaked in 1999, and mine production of gold declined from 1999 until around 2009, and it started rising again the last couple of years now. But silver has continued to rise. That reflects both interest and increased production at silver mines, such as some of the ones that you're hearing about here today. And it also reflects increased silver production at copper, lead, zinc, and gold mines where it's a byproduct. But you've seen an increase in market share on the part of primary production, which tells you that people are going after the silver more than they used to. Mine production is rising in a lot of different countries. Mexico is the largest producer. Peru had surpassed it for a couple years ago, but it's sort of plateaued. Mexico is now the largest producer. And China has grown very sharply as a silver producer, mostly as byproduct of base metals, but there is some co-product in there. And this is why production is rising. The relationship between the average cash cost of mining silver, and this is just the primary producers, and the price of silver has spread out sharply. So you have much more profitability in the silver mining industry than you used to. And even though you saw a sharp increase in silver cash costs last year, the increase in silver prices was even more dramatic, so that the profit spread rose. The average cash cost was about $8.28, and you can see back here that prior to last year, the average cash cost was probably around $5.60. So we did see a big increase in the cash cost last year, but it's still relatively good. And you have a robust production pipeline. These bars represent projects that we have in our database that are either coming on stream in 2012, 2013, 14, 15, or beyond that. These are projects that are in advanced stages, so they're not exploration stages. They may be in feasibility, or they may be in financing, or they may be in design and construction. And you can see that you're looking at about 150 million ounces of gross new capacity slated to come on stream over the next 4 years. in a market where about 770 million ounces is produced per year. So you have a big pipeline. Fabrication demand also is rising. It did reach a plateau in the late 1990s, and it did fall in the early part of this century, but it has been rising a little bit, and I'll break that down. Photographic papers, formerly the largest use of silver, peaked in 1999. Technology is replacing this with digital imaging, and you've seen a steady erosion of silver use in photo from more than 250 million ounces 12 years ago to probably less than 100 million ounces this year. Electronics demand is rising sharply. Silver is the preferred metal if you can get away with it, because it's cheaper than palladium or gold, and in some applications it's cheaper or better than copper. So you've seen a sharp increase in silver use in electronics over the last decade, which is taking up some of the slack from the photo. And then another big use are solar panels, and we've seen this tremendous growth. This is an industry that wasn't there 10 years ago. It was using 1, 2, 5 million ounces. 5 years ago, it was using 5 million ounces. We saw this very large increase in solar panel production and installation, and a tremendous increase in the amount of silver that was being used. And you can see that the installations lagged production. So what you had was in 2010, 2011, big increases in the production of these things and a buildup of uninstalled panels, which came home to roost in the second quarter of last year. And you saw the solar industry start to cut back. And you can see we have a little bit of a reduction this year projected for silver use and panel production as the industry tries to adjust that. Falling module prices are good for this. This silver photovoltaic energy is still not quite competitive with traditional sources of electricity right now, but the cost of photovoltaic panels is declining, which is helping it become more competitive. Our view had always been that solar would become competitive primarily because oil prices would rise to a point where solar was competitive with it. Our oil view price is changing a little bit, but we still think that you'll see tight oil prices by a historic standard for the next several years, which will contribute to interest in solar energy and help boost that. Jewelry and silverware is the largest source of demand now, and it has been relatively stable and continues to rise over the last few years. It's probably been stronger than the economic models would suggest. With the higher silver prices, you would expect lower demand. But with the higher gold prices and higher platinum prices, what you're seeing is consumers of silver jewelry buying more silver jewelry because they can get more dramatic pieces at lower costs than they can with gold and platinum. That's it. So we have plenty of time. I guess I shouldn't gloss over that. Matt would get mad. We produce the annual Silver Yearbook, which you can purchase from us online is the easiest way. We have a long-term study that has projections for supply, demand, price over 10 years under 3 different scenarios. We have monthly reports on the precious metals and the base metals, and we have special studies across other markets. And let's open it up for questions. I think we have a few minutes here. Do we have a microphone? Questions? Tom, you came all the way.
What do you think the possible inventory of silver is in China?
Well, it depends on whose inventory you're talking about. I think the Bank of China used to be the market maker there, so they had a large inventory of metal because they were the buyers and sellers of last resort within China. They got out of that business in 2000, 2001, and they sold off most of their inventories, from what we can tell. As they got away from being the national market maker, they continued to sell silver for domestic refiners. So the Bank of China was still seen in the international silver market selling silver, and some people assumed that that was from their inventories. In fact, what they were doing was, because you had these refiners who, under the system, you could say the communist system, but it's still a communist system. Under the system prior to 2000, 2001, smelters and refiners had no experience selling their silver overseas. So when they were finally given the freedom to do so, they basically hired the Bank of China to be their agent, because the Bank of China knew how to do that. And that continued until a few years ago. So our view is that the government and the Bank of China probably has very little inventories. Industrial users of silver definitely have inventories, and investors definitely have been buying silver. You have to remember, prior to, well, going back to the 1900s, Europeans and the Americans dumped billions of ounces of silver into China to pay for all of the things they wanted from China. And the Chinese didn't want wool and gin from England, so they said, well, we'll take the silver that you pillaged from Latin America, we'll take that. And prior to the communist takeover, China basically was on a silver coin monetary system. You had decades of civil war after civil war with a Japanese invasion thrown in between. And during that period of time, there was no effective central government, and there was no effective central currency. And in that environment, the major currencies that you saw prior to 1949 were Spanish, Cuban, and U.S. silver coins. So when the communists took over, there were billions of ounces of silver held by individuals. You could call them investors, you could call them consumers, you could call them people. And they've been consistent sellers of that over the last 60 years. And some of that still is there, and it seems to us that they've been buying more silver in the last few years too. Oh, okay. Okay, yeah.
Several questions, okay. Okay, one of them just went out of my head, so we'll start with one.
Well, Kaisa has a question too. So, no, you start with yours.
Okay.
We'll spread the wealth.
All right, thank you. Remembered it. Okay, let's say things do get much more shaky in Europe, which they probably will. Do you anticipate a flight to safety to precious metals or to the dollar, or can you explain what your astute assessment of what might happen in terms of the precious metals market?
In a scenario where the financial stability of Europe deteriorates even more sharply, and I should defer to your table mate on that view, but in that environment, we would expect a flight to quality and safety that would benefit gold to some extent and silver to a lesser extent. One of the differences between gold and silver has always been less of interest to European investors for some reason. You know, when the Europeans brought all that silver back, and it wasn't necessarily the British, it was the Spanish and the Portuguese and the Dutch, brought all the silver back from Mexico and South America. What they did is they took it across the channel to England, because England had the bimetallic system, and said, you guys want the silver? Here, give us your gold. And so they were taking the silver from Latin America, but they didn't necessarily want it. And Europeans, generally speaking, have never had as dynamic an interest in silver as they have had in gold. So if we saw a serious worsening, you know, Greece leaves the ECB, Greece leaves the euro, Greece goes bankrupt, Greece goes back to a drachma, which is worth 20% of a euro, heads on sticks, you would expect to see some investment demand for gold and, to a lesser extent, demand for silver. But let's take just the last 2 weeks as an example. The Bank of Greece estimates that 700 million euros have been withdrawn from banks. Billion, 700 billion euros. Yeah, I'm sorry, I'm old school. I think millions are important. No, billions. 700 billion euros have been withdrawn from Greek banks. Most of that hasn't shown up in gold or silver. Almost all of it went into the dollar. So we think the dollar would be the prime beneficiary. I think gold would definitely benefit some, and silver would benefit even less.
And maybe sort of related to that, with the credit drying up, how do you see that impacting your forecast for the success or the efficiencies of the mining companies and their markets and people being attracted to them because of the financial crisis? How do you see that dynamic playing out?
Can you explain exactly a little bit more what you're thinking?
Yeah, okay. So, as I understand it, banks aren't lending. This is a problem
Yeah.
for a lot of the smaller companies in terms of going forward, in terms of development and cash. So if or when the Europe crisis continues to become more uncertain and more shaky, how do you see that whole dynamic as it would play out for the mining companies versus the commodity?
Well, I think that the fact that banks have pulled back severely on their lending is problematic for mining. I mean, that's a given. And we're actually, our investment banking group is working on a silver-denominated financing for an emerging producer right now because, quite frankly, they need money. Banks won't lend them money, but they have silver in the ground, which they can use as collateral. And you probably will see an increased activity along those lines. You know, I mean, we saw gold and silver lending for project financing purposes in the 80s and early first half of the 90s. And I wouldn't be surprised to see something like that return to the market over the next few years.
But do you see a kind of AFXB immediately kind of thing? Do you see some sort of abrupt impact in terms
No.
either negative or positive towards the miners?
Well, I mean, the negative is that the miners, like everybody, are starved for cash right now, and credit terms and credit availability has become simply much more stringent, and that's going to continue for some time.
Okay.
Okay.
So I have two questions. The first one is, what do you think about the weakening correlation between precious metals and the dollar? And then the second one, it definitely seems that with gold producers have lagged the actual commodity. It's happened to a certain extent with the silver producers also. Do you think that the producers would catch up, and when would that happen?
Okay. The effects of my overnight flight. The first question was the... Yeah. In past years, we've shown a chart which is either the CRB versus the dollar or gold or silver versus the dollar. And what we've seen is that historically, the relationship oscillated from negative 90% to positive 90% with great regularity. And with two exceptions. One was in the mid-'70s, and the other one was since 2006. And since 2006, from 2006 until 2011, you saw a high and persistent negative correlation between silver prices, gold prices, commodity prices, and the dollar. And what that told us was that you had all this hot money coming into mechanically driven funds that were raising money for commodity funds or silver funds or gold funds. And the managers were saying, well, what are we going to do with 200, 300, 500, $1 billion worth of money that we're supposed to be investing in silver? And the manager, their bosses would say, just trade against the dollar. So you had this self-fulfilling prophecy of a tremendous amount of relatively hot, mechanically invested money. Whenever the dollar weakened, they'd buy more silver. Whenever the dollar would strengthen, they'd sell it. And we've said for several years that we thought that would end at some point. We weren't sure what would cause it to end, but we thought that there could be a very interesting readjustment. And it may be that we're starting to move in that direction. I mean, one of the things that we're seeing in the asset management category right now is that a lot of these short-term momentum-driven, black box-driven commodity funds are actually, they didn't do too well last year. They're starting to lose money, both in terms of actually losing it, but also having investors pull money out. And you're seeing money revert to macro-driven funds. So if you look at like the ETF and holdings of metals, you'll see a lot of short-term guys who just draw lines on charts getting out of gold and silver. But the total holdings of gold and silver and ETFs are staying up because more macro-driven guys are saying, well, if you're selling the silver and you're driving it down to $27 or $28 or $29 an ounce, I'll buy it because I like the fundamentals of silver. I've actually read the book, and I like the economic outlook, and I have a more sanguine view of the economy. So you're seeing people move away from that kind of short-term mechanical investing in gold and silver to more fundamentals. And that is likely to be reflected in a reversion to the more historical pattern. So I think that's what you're seeing. And I think it's going to continue over the next couple of years. In terms of the relationship between gold and gold equities, silver and silver equities, yeah, over the last decade, you've had a widening disparity between mining shares and gold and silver prices. Our expectation is that going forward, we expect gold and silver shares to outperform gold and silver bullion prices. And it's sort of a tautoculous argument. One of the reasons why we say that is because we believe that gold and silver have reached cyclical peaks. So you have, in the cases of gold and to a lesser extent silver, the vast majority of investors buy it for capital preservation purposes, and they're still buying gold and silver. But you have the market's made at the margin, and the marginal investors, and maybe 10, 20% of the market, so it's a big margin, are shorter-term capital appreciation people. And if we're right and the prices of gold and silver have stopped rising, but don't fall back, I mean, we're looking at gold staying above $1,400. We're looking at silver staying above $20, for the foreseeable future, for the next 10 years. In that kind of environment, investors will say the capital appreciation potential in gold and silver is down, but these companies are still very profitable. $8.50 cash cost, $20, $25, $27 bullion price. These guys are still very profitable. So one of the I guess we have three preconditions that we're looking for a shift in investor funds back to equities. The first one is that gold and silver bullion prices stop rising, which we think they have done. I can't remember the second. The second one is that mine production continues to grow or continues to grow in the case of silver at primary silver producing companies, and that's happening, and continues to grow now. It's been for 3 years, and gold continues to grow. So you have companies that are not only gold and silver producers, but they're growth stocks. Not all of them. Somebody who's producing several million ounces a year is going to be spending a lot of his time just finding replacement reserves and not necessarily growing production. Some of them will. I mean, Barrick expects to go from 7 to 9 billion ounces, and they probably will do it. So they're still a growth stock. But, the mid-tier companies and the smaller emerging producers, those guys probably should do very well. And the third precondition is that the companies have to produce attractive returns for the investors, measured not in terms of the number of ounces they're producing, but the dollars of profit and dividends. And you're starting to see producers move in that direction. So that's the third precondition. We're waiting for it to more fully emerge, and then we think that you'll see equity prices start to catch up. Other questions?
Just as a follow-up to that, you see very clearly in those charts that the spread has widened, but between the cost of production and the prices that they receive. Mm-hmm. But the profitability hasn't actually followed up, at least for some of these companies. What is going on? I mean, basically, you have companies that net of, other metals can produce silver at, $2, or sometimes they show negative cost, but their profits aren't, what.
Right.
What.
I'm going to say something that's almost it, on the surface, sounds contradictory with what I just said, but it's not. The chart that I showed you is cash costs versus the price of silver. And there's another component, which is the non-cash costs, operating costs. So your G&A, your amortization, your interest rates, your exploration, your overhead. And if you are, the cash costs, and to some extent even the total cost, data, the averages mask a wide spread. And you have a company like Pignoli's, which is producing 32 million ounces of silver, and their G&A is spread over 32 million ounces. You have a lot of other companies that are, producing 1, 2, 3 million ounces, and their operating costs are spread over a much smaller base, so they have a much higher non-cash cost. And I think that's what you're seeing in the profitability. So what you need to do, and Bob was speaking very eloquently about this in his Great Panthers talk, you need to increase production to lower that cost per ounce and increase your profitability. But it's not growth for growth's sake, it's growth for financial returns. And that's what you really need. I think that's what you're seeing.
That would bias the investment to larger companies as opposed to the smaller.
Well, my bias is toward smaller companies that are well-run that I expect to become larger companies. Any other questions? Tom, Oliver.
Hey, Jeff, about 100 years
You
ago.
got to use the microphone because we're actually broadcasting this. You want to talk about that bet we made?
I think it was 100 years ago when you rightly told me that the key to the future of silver market would be investment demand. So rationally, because of what we've experienced in the last 10 years, can't you see a global investment strategy whereby many more investors would accumulate 5 to 10% of their portfolio in gold and silver, which would create a huge amount of demand? I mean, today, what is it, just 2% of people own gold and silver, or an institution?
Oh, it's much smaller than that.
Yeah, so I mean, that's so small. Can't you see that widening to 2 or 3% or something like that?
Well, I don't think it'll get to 2 or 3%. I mean, the argument for expecting silver prices to stay well above $20 for the foreseeable future is that investors will continue to buy silver, and that should keep the price high. But one of the things we've seen since last summer in gold and silver, which I think we'll see going forward, is a greater price sensitivity on the part of investors. First off, if you're an investor, and in the United States and in Europe, people say, well, what percentage of my wealth should be in gold and silver? And, in gold, it's now up to 0.8%, and in silver, it's less than 1/10 of 1%. It's minuscule, the amount of private wealth that is held in silver right now. But you are seeing people buy that. And people will say, well, I should have a percentage of my wealth in silver. As the price of silver rises, the percentage of their wealth that's held in silver increases just by virtue of the price. I know the numbers for gold. If you look at gold has gone from 0.2% of private wealth to 0.8% over the last 12 years, and 2/3 of that reflects the increase in gold prices. Only 1/3 of it actually represents this historically large amount of gold purchases. And I imagine the same is true, probably even more so with silver, because the silver price has risen even more in percentage terms than the gold price. So, what I'm trying to say is there are natural breaks to the upward price pressure that will be seen in silver due to continued investment demand. One is that as investors buy, they push the price up. They push it up to a point where they say, I don't need to buy more because my percentage of my wealth that's in silver is higher, especially if everything else is going to hell in a handbasket, right? And the second thing is they push the price up to the point where they say, I'm just not going to be a willing buyer at these levels. So what you'll see, and what you have seen since last summer in silver and in gold, is that when investors come in and they start buying, price comes down, they start buying. The price starts rising because it's a very thin, illiquid market. And when it gets to a certain level, they stop buying until it comes back down again. I had a gold bug talk to me a few weeks ago, and he said, no one wants to hold dollars or euros anymore. And I said, well, you have $2 trillion of wealth in gold. You have $65 trillion of private wealth in bank deposits, cash, and cash equivalents. You have 33 times more people saying, I'm going to put this in a CD earning 0.25% denominated in gold or dollars or euros rather than gold. Now, that cuts both ways. It talks about the extent to which investors, a lot of investors, just won't buy gold and silver. But it also talks about the fact that even a minuscule change in those attitudes has a dramatic effect on the prices. And it has had a dramatic effect over the last decade, driving gold and silver prices higher. But now you're finding this greater price sensitivity because whereas until last September it was, I have to buy gold and silver today regardless of the price because it's going to the moon. You know, some guy on the internet said it's going to $300 an ounce for silver. And somebody said, why am I taking all of my wealth or even a part of my wealth and investing it based on somebody who's using a nom de plume on the internet, who's probably sitting in his basement in his underwear typing away, or in the case of one guy I know living in a condo in Saskatchewan, I think, you know, the heart of the silver market here. You're having people re-examine that. And they say, no, wait a second. I think it still makes sense to buy gold and silver, but not necessarily to chase it ever higher. I think that's what you're seeing. We are just about ready to start our next session. You're going to take over for me again? Thank you.